Good afternoon, friends. Am I audible? Okay. So, as Pinky ji was introducing me and she forgot mentioning advocate in the beginning, somebody in the tribunal, a very senior counsel, asked me, he said, Sunil, you're PhD, you're doctor, you're advocate. Why do you yet write CA? Because normally, Aam Janta considers this as a better this thing. I told him, something, if I have to sit the PhD exam again, I will do it easily. LLB even more easily. But the CA exam, I will say Bhagwan. So it is something of all the degrees, I'm most proud of the CA degree. And I can share this with you that though advocates, counsels, doctors are considered more qualified, but the very fact that each of you all is a CA, that itself is a very, very big achievement. And I'm saying this from my own experience. Now, being an advocate, I've been out of touch from the institute. And here I would want to thank Ketan Bhai Sayya for inviting me and reconnecting me to the institute. So my thanks to him for this opportunity. My sincere thanks to Jayesh and his team. I don't know where's Hiloni and Sian. Can you all just stand up, please? So these are these two young girls, the articles, who helped me a lot with this presentation. I gave them the content, but they could present it the way I wanted them to. So thank you all. Thank you very much. And also my one ex-colleague, Harsh Shah, he's not here, and he has helped me on the international tax and TP case laws. So friends, what we have done, we've tried to cover 20 case laws, which is going to be a challenge in this short time. Because I was informed that first it's a 2-hour session, but 2 hours there is a tea break and there is all that. So we'll see how to manage that. Now, I was also told that the audience here, by and large, are domestic tax audience and not much into international tax and TP. But friends, the fact of the matter today is if you go to Mumbai Tribunal, then 30% of your benches are dedicated for international tax and TP. So times have changed. So I have taken 30% of these cases for international tax and TP, which has a domestic tax flavor as well. And I hope, we'll be able to all relate to that as well. So 70% domestic and 30 is international and TP. Number of different kinds of cases, which you can see on the index, you can see capital receipt, capital gains, income from house property versus business income, 56 to 57, penny stock, revision qua bogus purchase, revision qua share capital, penalty. And these are 15 to 20 are all international tax and TP cases. So friends, here what we have done, if you see, we'll be skipping slides. So please don't feel cheated, I prepared so much, you're not going through it, because I think these slides the presentation will be shared with the participants, or later on it will be shared. So it is going to be with you. When the screen comes on, if you can just read the bold part or what is in blue. Blue is something in favor of the SSC, and if something is in brown, it is against the SSC. So that kind of color coding will help. And if I may be skipping the slides to cover all 20 cases, but this PPT will come to you, so don't feel cheated on that, please. So friends, when we come to case laws, in common life, in normal language, a small comma in a sentence can change the entire meaning of the sentence. So let's take 4 words. Roko, in Hindi I'm saying, roko, comma, mat jane do. Roko, comma, mat jane do. Now you change the comma. Roko mat jane do. So you're seeing a small comma here and there is changing the entire meaning of a sentence. And the same can happen with words. One word in one case is interpreted in a particular way. The same word in another case is interpreted in a different way. And that is the real challenge and the enjoyment of going through different cases to go through different interpretations. With this background, friends, let me come to the subject proper. And this is the first case where we are dealing with a case whether of rent. Now, friends, as we understand rent, as we normally understand, if I'm having a rental, if I'm getting rent, then clearly it is taxable. It's a revenue receipt. Now, here is a case also, friends, the issue, if you see the issue is such that if you read the issue properly, you will understand the facts itself. So I have not reproduced the facts. It will just come out from the issue itself. So here is a case where, in Bombay, redevelopment is happening. The builder tells the person, okay, you vacate your flat and within 3 years, I will give you a new flat in the same building. And I'm giving you what they call transit rent. For 3 years, you go live on rent somewhere. And this is, we'll come back to you. There's a situation happening in Mumbai. The question arises whether this rent, is it a revenue receipt? And if so, then is it liable for TDS under 194I? So if one sees the provision 194I, rent means any payment under any lease, sublease, tenancy or any other agreement for the use of building. Now, when I am receiving rent, I have to pass on this to somebody else. So as far as I am concerned, the money is coming from the builder, it is going to another person. So if you go strictly by the meaning of the word rent, then in this particular case, the transit rent will not be a rent. The rent which I am getting is really not as my income. It is really a hardship allowance. If you can see what is written in bold, or what we call a rehabilitation allowance or a displacement allowance. So clearly this transit rent, it was held, is not a revenue receipt. And they relied on some other decisions which are there on the slide, which will be shared with you. And they said normally compensation is paid by the builder on account of hardship faced by the owner of the flat due to displacement. So therefore, this does not have the nature of a revenue receipt, and this will be held to be a capital receipt. Now, since we are on the topic of capital receipt, we are on the topic of interest, I'm taking two more cases. So friends, one other thing, the case laws which I have taken are those which have been rendered in the last 1 year, because I presume the earlier session 1 year back, they would have covered the latest. So this is by and large 12 to 15 months what has been delivered. So all the cases will be 24 or 25 delivered in 24, 25. Now, there is another case of a capital receipt. So here was a person where he deposited certain amount for an auction. There was a property being auctioned and he deposited certain money. That auction was nullified for whatever reasons, and this deposit money came back with interest. So normally interest income is a revenue receipt taxable, but in this case, it was held that no, it will be a capital receipt. This is a Delhi decision. The next decision is in a mall, the shopkeepers who are taking it on rent, they pay rent to the mall owner. They also pay something called common area maintenance charges, what is known as CAM. Now, whether this CAM and rent he is paying together, so does CAM also amount to rent? And it has been held that no, CAM will not amount to rent. So these were two connected issues on the topic. The next issue we come to now is that regarding capital gains and transfer. So here the issue is whether reduction in share capital of a subsidiary company would amount to a loss. And if it is a loss, then can I claim that loss and set it off against some other capital gain? Can I carry it forward? So the main thing is, for it to be a loss, capital loss, there has to be a transfer. And does reduction in share capital amount to a transfer? Now, this is a judgment of the Supreme Court. The earlier case was of the Bombay High Court on capital receipt transit rent. This is of the Supreme Court. Supreme Court has went by the definition of transfer and said transfer includes sale, exchange or relinquishment of an asset. Then they relied on the old decision of Supreme Court in the case of Kartikeya Sarabhai and held that in that particular case it was written that a reduction in capital amounts to extinguishment of an asset. Now, somebody may argue that in what way it is a transfer yet, because the person still continues to be a shareholder. There's nothing, he says was a shareholder before, he's a shareholder now. And this is what the Supreme Court held. That while the taxpayer, like in a sale, when you sell your shares, you're no more a shareholder. In reduction of share capital, you're still a shareholder. So where is the transfer? So Supreme Court held that where the taxpayer continues to remain a shareholder of the company, even with the reduction of share capital, it could not be accepted that there was no extinguishment or any part of his right as a shareholder qua the company. When as a result of reducing of the face value of the share, the share capital is reduced, the right of the preference shareholder to the dividend or a share capital, and the right to share in the distribution of net assets upon liquidation is extinguished proportionately. And to that extent, there is a reduction of capital, there is extinguishment, and there is a transfer. And so here in this particular case, the assessee on a reduction of share capital could claim a capital loss. Now an issue arises that normally when you compute capital gains, you have consideration less cost. So here there is a cost, but there is no money coming to me, there is no consideration. And the Supreme Court here referred to the Gujarat High Court decision of Jai Krishna Hari Vallabh Das and said that a consideration is not a prerequisite for a transfer. A transfer is independent of a consideration. Now, friends, it is said in the Gita that what gives us the maximum pleasure can also give us the maximum pain. Now, this is a favorable case, but really this case can also be used against the assessee, as it happened in the case of Karthikeya Sarabhai. And in this particular case, reduction was held to be a transfer, but in this particular case, the assessee had acquired a share for, let's say, 450 rupees. The face value was 1000 rupees. When there was a reduction, he actually got back from the 1000, it became 50, and he actually received 950 back, though he had paid 450. So in this case, it was capital gains was held to be taxable. So it can go both ways, but I would think it's a correct decision on extinguishment and it being a transfer. Now we come to the next case of Calcutta High Court. Now here the issue is, here the assessee, Anuj Agarwal, he had got an office and he was given a letter of allotment for the office. After the letter of allotment, the entire sale consideration was paid, but the possession was delayed. The execution and the registration of the agreement was delayed. And when he sold that office, the issue arose as to what is the date of acquisition of the office for the period of long term or versus short term. Now, to decide this issue, the relevant provision is it's important to go through it. Now, explanation 2 to 247, which talks of transfer, says the transfer includes disposing of or parting with an asset or any interest therein, or creating any interest in any asset in any manner whatsoever, directly or indirectly, by way of an agreement or otherwise. These words are important: directly, indirectly, agreement or otherwise. Now, if one looks at this, the issue is whether letter of allotment can lead to a transfer. This is what Calcutta High Court held. They said that payment coupled with terms of allotment, payment, important point. So if one tries to manipulate and just have a letter of allotment, that may not work. Payment coupled with terms of allotment had created an interest in the asset. And the words are agreement or otherwise, and otherwise is wide enough to cover even a letter of allotment. And then they relied on certain cases under the civil law. Now the Calcutta tax bench of the High Court is relying on certain other cases under the civil law in similar facts. And they said that in such a situation, this is what they held. It cannot be disputed in the civil matter that a letter of allotment, unregistered and unstamped, did not create a legal right to the property. But nevertheless, some right concerning the property had been created in favor of the appellant therein, and the SLP has also been dismissed. So they took this civil case as a base and said that the allotment, at the stage of allotment coupled with payment, the transfer was complete and therefore it would amount to a long-term capital gain. Now the other issue arose that the department was arguing that there was no possession given, and as per 247, and if you go by the provisions of Transfer of Property Act, then possession is covered within the word transfer. And since possession was not given, there was no transfer. So friends, in this, the section is expanding the meaning of transfer. It is not restricting it. So there can be a transfer on possession, but merely because there is no possession, it does not mean there is no transfer. And this is what they took cognizance of. And they also relied on a Punjab and Haryana High Court. So this is Calcutta and that is Punjab and Haryana, which is And they said in similar facts, even in the Calcutta High Court, Punjab and Haryana High Court, they held that when an allotment letter is given, an interest is created and the transfer is complete. Now, friends, on this word allotment, as I was telling you, there can be, in the first case, we said rent. Normally it is revenue receipt, it was held to be capital receipt. Then the second case, we said interest, normally it is revenue receipt, it was held to be a capital receipt. Now, here is a case of allotment. So, in common parlance also, when we use certain words, so if I'm telling Heloni that have you completed the PPT, and she says yes, I have finished it. She's saying finished and I'm saying completed in the same way. But I remember when I asked a friend of mine, a couple of mine many years back, I asked the girl, how is life after marriage? And she said, oh, my life is complete. And the husband said, my life is finished. Now, there the meaning was totally, the word finish, when Heloni says, I've finished my work, means I've completed work. When that husband said, my life is finished, he meaning it differently. Now, just see here the word allotment. Here they are saying, in allotment, there is a, allotment letter mein, there is a transfer. Now, I remember many years back, Mr. Soli Dastur, the legend, he's 90 years old today, big fan of his. He was arguing a case on explanation to section 73, which is deemed speculation loss. And the section says when the business of a company comprises of purchase and sale of shares, it shall be deemed to be a speculative. And Mr. Dastur argued that no, in his case, the client has been allotted shares. It's a direct allotment, and that allotment is not purchase. Now, purchase means a transfer, but he said allotment is not purchase, and he succeeded. In Calcutta High Court, they have said allotment is transfer, and they succeeded. So it's just how a particular word can be interpreted in the right context is what is all these judgments and litigation all about. So this is one interesting case of the Calcutta High Court. Now, since the issue here was to know the date of transfer, to know long-term or short-term. Now we come to a case of, this is a special bench decision of the tribunal in the case of SKF. Now the issue arises here is, I have an asset, I'm claiming depreciation on it, section 50 is applicable. Section 50, as we all know, and which is there on the screen also, section 50, it says notwithstanding anything contained in 48 and 49, which is fine. And it also says that the gain which arises out of 50. So if my sale consideration is more than the WDV, then the gain shall be deemed to be a capital gain arising from transfer of a short-term capital asset. Deemed to be capital gains arising from transfer of a short-term capital asset. And this phraseology is used twice. Now in SKF case, the issue arose that it's a depreciable asset. There is a capital gain, but the assessee wanted to claim 20% rate of tax at that point in time for long-term capital gains under 1112. The case of the revenue was that, look, the section is very clear. It shall be deemed to be capital gain arising from transfer of a short-term capital asset. So if it is deemed so, then how can one claim the benefit of 112, which is for long-term capital asset? Now, section 112, and this one line is missed out here in the beginning, says that where the total income of an assessee comprises of any gain arising from transfer of a long-term capital asset, then it will be 20%. So here in the block, section 50 block, the asset was more than 3 years old. So if one goes by the definition, it was clearly more than 36 months. It was clearly a long-term asset. But section 50 says it shall be deemed to be short-term capital gains. So the issue arose, can one claim long-term rate for a deemed short-term capital gain? That was the issue here, though the period of holding was more than 36 months. So this, now here, imagine the special bench is constituted of the tribunal. When does this happen? When there are two contrary views of two different benches. Then the tribunal says, okay, we'll make a special bench of 3 members. Normally, a matter is decided by 2 members. A special bench comprises of 3 members. And what the 3 members jointly decide will become the law all over tribunal, all over India. The special bench will be followed. Now, it so happened here that 2 members took one view and one member took another view. So this is the majority view what you see here. So the majority view is that if you go by section 50, section 50 says capital gain is computed under 48 and is normally computed under 48 and 49. But by 50, it amends the computation of capital gain. So what happens, if I have, normally there would be consideration less cost of acquisition. Now, if section 50 comes in and I'm yet saying, no, cost of acquisition should be what I bought for, then section 50 is effectively saying, look, you have been depreciated. So you won't go by 48 and go by cost of acquisition, you will go by the WDV. And that is the object of section 50. So they said, look, this is the object of section 50. It is more to do with substitution of cost versus WDV, and it is not for the rate. And as regards the rate, if you see, they relied on a Bombay High Court judgment of Ace Builders. Now, Ace Builders is a case where there was a depreciable asset under section 50, and the investments from there, certain investments were weighed as prescribed under section 50E. 50E starts with the language where any gains arising from a long-term capital asset is invested in these things, and you will get an exemption. So Bombay High Court said that section 50 is maybe deeming it as a short-term capital gain, but it cannot convert a long-term capital asset into a short-term capital asset. It will still remain a long-term capital asset. And once it is a long-term capital asset, then notwithstanding it is under section 50, they will get the exemption under 54E. And the tribunal, in the majority view, took that view of Ace Builders. And they also noted, if you see the last bullet here, Ace Builders has been kind of affirmed by VS Dempo Supreme Court. Now, Supreme Court again was a case of 54E, and Supreme Court said that, look, 54E does not make a difference between depreciable asset and non-depreciable asset. So if one goes by the same logic, 112 also doesn't make a difference between depreciable asset and non-depreciable asset. What is important is it should be a long-term capital asset. If the asset in the block was held for more than 36 months, it continued to be a long-term capital asset and one could get a lower rate of tax. So this is how the majority view was. Now, so it relied on Ace Builders. Now, the minority view, strangely, is also relying on Ace Builders and taking a view against the SSC. So they are saying that if we take the view which is taken by the SSC or the majority view, then the section 50 provisions will be rendered OTOs. Now, that may not be so, because in section 50, at least the cost of acquisition is still being substituted by the WDV. So it's not something which has become redundant. What the minority view is saying, that may not be, this line may not be correct at least. And then they said they relied on Ace Builders. If you see the second bullet in brown. So as I said, anything in brown is against the SSC. So here the minority view is against the SSC and he is relying on Ace Builders and saying that in Ace Builders it is held that the object of section 50 is to deny multiple benefits to the owner of depreciable assets. Now the issue is multiple benefits is it that you can't claim cost of acquisition twice and therefore it's a multiple benefit, or is it also vis-a-vis the rate? So since the minority view and the majority view strangely are both relying on the same judgment of Bombay High Court, this issue will eventually have to be decided by the Bombay High Court and eventually the Supreme Court. But as of now, the law as it stands as per special bench, a depreciable asset which has been there, which you're holding for more than 36 months, which is long term, one can claim a lower rate of tax applicable to long term capital gains. Now, the next case we come to is a Mumbai tribunal decision of Sheila Ramchand Uttam Chandani. Now, this is a case of section 54 exemption was claimed by this lady. And before I come to the fact here, what does the section say? The section says that exemption will be allowed to the SSC if he has within the blue part, as within a period of 1 year before or 2 years after, or after the date on which the transfer took place purchased, or has within a period of 3 years after that constructed one residential house. So if the SSC has within a period of 3 years, constructed a residential house. So the issue arises is, does the assessee have to get a contractor and say, okay, construct it? What happens in places like Delhi, Noida, and you have a take it, a contractor who does it, or can it also be to an under construction flat also? This was the first issue. And the second issue was, assuming one can get this under construction flat, what if the builder has not completed it within 3 years? Then do I lose the exemption because the builder has not completed it in 3 years? Because the condition is that the construction he has constructed within 3 years, meaning thereby that the construction is completed within 3 years. So two issues. Can one get it for under construction flat, or do I have to construct it myself? And assuming the answer is yes, what if the builder has not finished the construction? Then the condition, so to say, is violated because it is not constructed only. So this is what the tribunal held. If you see the first bullet, they relied on a few decisions and said, okay, no, when an under construction, what is important is the flat should be constructed. Who construct is not relevant. And they relied on certain decisions which you see on screen. If you see the last, in the second bullet, the blue line, where assessee himself, whether the assessee himself constructs the house or he gets it constructed by a contractor or a third party, that does not make any difference. So one can go for under construction. Now the issue arises is, what if the flat is not complete? I have made the payments, and these things happen in Mumbai, or not Mumbai, all over India. There is a delay of the builder. Should we suffer for that? And this is what comes within the domain of what I call a judge-made law. So other cases what we discussed, they were interpreting a particular word. Rent, does it transit rent, does it fall under definition of rent? Reduction of share capital, does it fall within the definition of transfer? So they are giving relief on the basis of interpretation of a word. Now here, if you go on the interpretation of a word, then clearly it is not constructed. And therefore the exemption may be denied if one goes on a literal interpretation of the section. And sometimes a judge, this is what we call a judge-made law, which is going beyond the provision. And this is what was held in a very welcome judgment. It was held that at this stage, it is needless to mention that the plight of the house buyer is not hidden from anyone. And in the recent past, due to one or the other reason, various housing projects by well-known builders across the country were getting delayed for no fault of the purchaser, who continues to await the delivery and possession of his flat. Even in these circumstances, the house buyer who intends to take benefit of Section 54 cannot be blamed if the construction of the flat is not completed within the period of 3 years from the sale of the original asset. And at least to the amount of the money which was utilized and paid to the builder, the relief was given. So a welcome judge-made law or case law on this point. Now we come next to a case. Now this is also commonly happening in all our family matters also. So if a capital gain has happened, somebody may want to put his wife's name in the new deed, somebody may want to put his child's name, in-law's name, parents' name, and things like that. And can an officer deny me the exemption because there is some other names put? So there are a number of tribunal decisions in the recent 1 year. So if you see in the column, name in the old asset was of the assessee and wife, and the new asset was bought in the name of the son, assessee and the son. In the second case, it was assessee's name, but it was bought in the parent's name. Now, in this case, the son was actually traveling and it was not possible to get it registered in his name. So it registered in the parent's name, and the parents later gifted this property to him. And the third case of Rekha, in this case, Rekha sold the property and constructed a property, but the land belonged to the husband. And in Simran's case, Simran again chose to buy the new asset in the name of the husband. So Eloni, Sian, keep this in mind. People are buying properties in the name of their husband also, and we are getting the relief. So in this particular case, it was allowed, and the reason given was that the section stipulates purchase of the new asset. It does not say that the asset must be purchased in your name. And therefore, a liberal view was taken, and they also took into account that the money is coming from the bank account of the person who had sold it. So this is very important. And they don't go by the name. So that theory ke naam mein kya rakha hai, the tribunal has actually followed what's in a name. So this is one of those, and all these cases are on the point favorable to the SSC. Now the issue arises in a reverse scenario. What happens? Suppose me and my brother are on the property together, and we sell the property, and my brother offers the capital gains. Can the officer tell me that, look, since you are also part of the sale deed, I will tax half the money in your name? And this is what actually happened in the case of Vinod Nihalchand Jain. And Mumbai tribunal noted that the brother had possession of the property, had 100% rights in the property, had offered that income in his return, and therefore merely because I'm a joint holder, that cannot go to penalize me. So this is the reverse scenario. So by and large, the tribunal in exemption is taking a view in favor of the SSC. The next issue which arises is, can exemption under 54 or 54F be denied if the SSC has bought multiple floors in a building or multiple flats or units? So let us say if he's bought a duplex. So currently in the, see, people are buying Jodi flats, duplex, triplex, and the section says you will get it for one residential house. So can the exemption be denied? So the Mumbai tribunal in all these cases, what you see on screen, has taken the view in favor of the SSC. And the reason is this. They are saying that, look, these are exemption provisions, beneficial provisions, which should be liberally construed. And what is important is usage as one house. So one may have a triplex, one may have a duplex. But if there is one living room, one kitchen, several rooms, if it is being used as one house, then merely because the agreements are two or two registered documents, that cannot be the basis to deny the exemption. Now, there is an old judgment of Bombay High Court in the case of Raman Kumari Suri. In this case, long back, two flats were bought and the exemption was granted. But the Bombay High Court said that the two flats were combined as one before the SSC bought it. So it had become one before he had bought it. But really speaking, the fact of the matter is, ultimately, am I using it as one residential house? And again, this is going with the realities. Today, people are getting prosperous. They are buying bigger flats. They are buying Jodi flats, duplex, triplex. And merely because they are doing that, that should not come in their way. Now, the same logic can also go against us. So here is a case of Iqbal Ali, again last year's judgment, Hyderabad Tribunal. He bought a residential house and claimed exemption. But Iqbal Ali was using that house as a mosque and was using it as an orphanage school. And what the tribunal held is that what is important is you have bought a house, but you have to use it as a residential house. The same logic earlier in a reverse way. And the exemption was denied. The next case, so we've finished the chapter of capital receipt, capital gains along with exemptions, transfer, etc. Now we come to income from house property versus business income. Now here is a case of MP Entertainment. The main object in the memorandum was, it was in the business of constructing, owning, acquiring, developing, managing, running, hiring, letting out, selling out, or leasing shop mall. And the issue was whether it is income from business or house property. Now, this is a case where the Supreme Court, where the SLP has been dismissed by the Supreme Court. And therefore, I thought it was important to cover this. Now, we are aware that on this issue, income from house property versus business income, there have been a number of Supreme Court judgments on the point, both taking contrary views. And this judgment is kind of listing those case laws, and therefore you get a crux of all of that in one case. So, if you see the second bullet here, Sultan Brothers case, Supreme Court, in this case, the SSC had let out a particular property or a building which was being used as a hotel. And the SSC said, look, it is business income because I've let it out. The hotel is being run there. And it was held, no, but you are using it as the owner of the property and it will be held as income from house property. So, Supreme Court took note of the judgment and said that one has to look it from a businessman's perspective. So here if it is one solitary asset and I'm doing it, though the hotel business is being run there, as far as I'm concerned, it is income from house property. And therefore, in this case, Sultan Brothers will not apply. Chennai properties will apply in this case because in Chennai properties, also in Supreme Court case, it was held that the business was that of letting out. And therefore, Chennai properties will apply. Now, if you see the last bullet, Raj Dadarkar and Associates, this was against the assessee. It was income from house property. And they said in this particular case, Raj Dadarkar and Associates, it could not be demonstrated that the activity of letting out was being carried out as in a systematic way as a principal business. And therefore, the adverse judgment of the Supreme Court here will not apply. So it considered the for and against judgments. And in this particular case, they held that going by the memorandum, going by the activity of the SSC, it was clearly be business income. And this is a latest Supreme Court judgment on the point. Now, we come to the next case. This is a Mumbai tribunal case of Anil Dattaram Pitle. Now, this is a case, now this we are dealing with section 56. So, we moved from house property. Now, we are moving to income from other sources, 56 to 10. Now, here is a case where redevelopment is happening. The particular assessee gives up this old flat, and in lieu of the old flat, a new flat is given to him in the society. And there is a difference in the stamp duty valuation of the new flat which comes to him and the stamp duty valuation of the old flat which he gives up. And the AO makes an addition under section 56 to 10 B, capital B, Roman 2. So what does 56 to 10 say is where any person receives in any previous year any immovable property without consideration. So then that's not the case. For a consideration, the stamp duty value of such property as exceeds such consideration if the amount of such excess is more than the following. So here the stamp duty valuation is more of the new flat than the old flat. And the AO says I will apply 56 to 10. Now this is what the tribunal held. Now with due respect it's a very brief order. If you see the judgment, it's a very brief order. And sometimes I realize is a very good learned member. But I realized that those are the days when he was on the approaching superannuations and he must be having a lot of orders to dispose of before he goes. And nice of him that he didn't release the matter, at least he passed an order, though a brief order, and this is one of them. So though it is not too detailed, but this is what it says. He said this is a case of extinguishment of old flat in lieu thereof a new flat was given. So this is not a case of receipt of immovable property or inadequate consideration, he said. That was his reasoning, the tribunal's reasoning. And therefore, the tribunal held that 56 to 10 will not be applicable. And this is important. He said, at the most, this transaction may attract the provisions relating to capital gains, and the assessee would be entitled to deduction of cost of new flat under section 54. So even if you go by capital gains, you'll get 54 exemption. And since there will be no tax liability, the addition was deleted. Very short order, but very helpful to the assessee. Now, we have another case, a recent case, which has just come last month. Again, Mumbai Tribunal, in the case of Basant Nagarao Barbade. Now, in the first case of Anil, there was a flat which was being given and another flat being received. This case was first case was Anil was the owner, here was a tenant. So he was an old tenant, so he gave up his tenancy and he got the new flat. So from a capital gain perspective, there's no difference really in the first case and the second case. And here also an addition was made under 56 to 10. What Bombay Tribunal held that surrender of tenancy rights is a capital asset. So there also surrender of a flat is a capital asset. It's a capital asset. Now, once it's a capital asset, what will come in is capital gains provisions. And once capital gains comes in, then you cannot go to other income. And you will have to go by capital gains, and therefore 56(2) will not be applicable at all. And this is what they held, that once an income from a source falls within a specific head, the fact that it may indirectly be covered in another head will not make the income taxable under the latter head, because it's the residuary provision. And it relied on the judgment of Supreme Court in the case of DP Sandhu brothers. Now, there was a case of surrender of tenancy where the AO made an addition as casual income under 10(3) read with other income. And Supreme Court said that no, tenancy right is a capital asset. It will get covered within the provisions of capital gains, and therefore other income and casual income will not even come into that particular case. And that principle was applied by Mumbai Tribunal in the second case in favor of the SSC. The next case is that of Deepak Sippi. Now, this also a case, these things are happening in Mumbai and even outside of Mumbai. So here is a case, the assessee made an investment with a builder, and for some reason the project could not take off, and the builder, his money, the amount invested with the builder was stuck. So this assessee went back to the broker through whom he had went to the builder, and he told the broker, "Ke Baba, please get my money back with interest, and I'll give you a brokerage for it." And it was a 50 lakh brokerage or something amount like that. It was a big amount. But you help me to get the investment made as well as the interest. And the broker succeeded, and he got the money. And he got, of course, the larger amount was the capital amount and the smaller amount was the interest amount. Now, the larger amount being a return of capital was obviously not taxable, and the smaller amount, which is the interest income, was taxable as income from other sources. So when it was taxable as income from other sources, the assessee said, okay, let me claim this 50 lakhs as a deduction under section 57. And 57 says that any expenditure laid out or expended wholly and exclusively for the purpose of making or earning such income. So now two problems in this section. One is the amount I spent is this much, and the income interest element is this much. So that was the first difficulty here. And second was that the amount which I have spent through the broker also is giving me a capital back. And this section says it should not be in the nature of a capital expenditure. So two hurdles, and this is a very welcome judgment of Mumbai Tribunal, and these things happen in real life. And this is what the tribunal held. The tribunal noted that the genuineness and the bona fides of the transaction was not in dispute. It was not some like an excuse to get, the broker was a third party, builder was a third party. It was a genuine transaction. So first thing. Second, they said, there is a lump sum brokerage paid with a specific understanding that the full amount will be received from the builder, which is the principal amount and the interest. And this amount is not something which is prohibited under section 58. Section 58, if the expenses of a personal nature, or if an interest expenditure is there which is paid outside of India, then they cannot be claimed. So the tribunal said this is not covered under the exceptions of 58. And they said this is clearly wholly and exclusively for recovering the amount of interest, and also happened that you're also getting the capital back. And this is the second bullet. The payment of 50 lakhs is a lump sum payment. The MOU is that there is no bifurcation or split of the expenditure. So I'm not telling the broker, I'll give you 10 lakhs if you get me interest, I'll give you 40 lakhs if you get me principal. It's a lump sum payment, and therefore you cannot do a breakup of that. There is nothing enabled in section 57(3) allowing the AO to estimate the incurring of expenditure towards the income. So the section does not provide for something like that. And once it is established that the expenditure has been incurred wholly and exclusively for the purpose of earning such income, and it is not in the nature of capital or personal expenses, the same is allowable. It is merely incidental that part of the money recovered is subjected to tax and part is not. And the expenditure must be incurred for the purpose of earning the income, though it is not necessary that the incurring of expenditure is profitable one or in fact income has been earned. So as I said, the amount is 50 lakhs, the interest amount is small. The investment is a larger amount. So let's say I'm offering 10 for tax and claiming 50. And they relied on an old judgment. If you see the second one, Atir Textiles, Gujarat High Court, what is mentioned there. Now, in Gujarat High Court case, the assessee had borrowed certain money and was paying interest at the rate of 18%. And it invested money in convertible debentures, debentures which would be converted to shares, and those debentures were giving 12%. Now, the 12% which I earn becomes income from other sources, and the 18% I pay becomes deductible under 57. So clearly, it's a loss for the assessee. And Gujarat High Court looked into the commercial aspect of the matter. And they said, look, the assessee is keeping in mind that this will get converted when you talk of the bona fides. It's a convertible debenture, and if this gets converted to shares, and these shares later on give him bonus shares, therefore, even if there is a loss, even if 57.3 does not generate adequate revenue, if it is for the purpose of earning the income, it is allowable. And a welcome decision of Mumbai Tribunal on this point. Now, the next decision we come to is that of Calcutta High Court in the case of Sawan Kumar Jaju's case. This is Calcutta High Court, penny stock matter. So, as you all know, penny stock, you buy at 10 rupees, that price becomes 500, you sell it and you claim capital gains exemption. So this was a similar case like that, and the matter reached High Court. And I'm taking only cases which have happened in the last 12 to 15 months. So when the matter reached Calcutta High Court, it noted that the tribunal has categorically held, which was in favor of the assessee. So blue is in favor of the assessee. The tribunal has categorically held that the assessee was able to demonstrate that the shares of the company in which the assessee has invested does not appear in the AIR report, annual information report of the revenue, which related to trading in penny stock. It was not tainted, so to say, in this particular case. The name of the alleged company did not appear in the name of those suspended companies. The assessee had submitted details to substantiate the claim. There was a long holding period, and the tribunal had faulted the AO in not considering the voluminous information placed by the assessee in the course of assessment proceedings. The tribunal also referred to the notice issued by Bombay Stock Exchange, wherein the trading in the company had resumed. So for a moment it was suspended, but it has actually resumed. So this was a fact. And the tribunal found that in the assessee's father's case, the same gain was accepted. The 1038 was allowed. What is not coming out here is, was it allowed in a scrutiny assessment or a 143.1? It's not coming out in the judgment. But whatever it is, it had some persuasive value. And here the commissioner had also looked into the factual position, voluminous documents, and given the relief. So the trend in the High Court usually is, when the tendency rather is more, when they say there are concurrent findings on fact particularly, they don't disturb it. So when both the lower authorities have accepted it to be genuine, and so the High Court upheld the order. So one of the recent High Court judgments in favor for penny stock. Now, since we are on penny stock, there are some connected issues, connected case laws in the last 1 year. So we have the case of Manish Shah, Ahmedabad Tribunal. Here also penny stock exemption was given. And what the tribunal noted, if you see whatever is underlined in blue, all that you have to see is that the assessee had received preferential allotment. And there was a lock-in period. The transactions were substantiated documentary evidence through banking channels. And it was allowed, 1038 was allowed. The next case is of Chandigarh Tribunal, again, latest judgment of 2025, Vikram Jain's case. In this case, the assessee had invested in a company, let's say X, that X company amalgamated with Y, and shares of Y was sold. So the Chandigarh Tribunal noted that the amalgamation had been approved by the High Court. And if it is, and a lot of weightage was given to the approval of the High Court. And though there was a statement of, if you see in brown, that what is against the SSC, there was one particular person or a broker or who does these kind of transactions who admitted that he had provided bogus long-term capital gains to a large number of clients through a syndicate of brokers and entry operators. What was noted in this case was that this statement was not recorded by the investigation wing in the presence of the SSC. The said statement had no relevance unless some corroborated evidence was being collected. The AIR report was not even supplied to the SSC and could not be termed as a gospel truth, which could be given preference over the judgment of the High Court approving the amalgamation. So one may keep in mind that this amalgamation, if it is approved by the court, then a case becomes pretty good, or a case of a preferential allotment, it is also a good case. Now the third case of Mumbai Tribunal, again in latest of 2025, Sangeeta Ben Mardia. Here they noted that the sale of shares was through a registered stockbroker and the copies of contract notes were available on record. And they held that no independent inquiry had been conducted by the AO. This is important because the AO is just doing a cut and paste of some other report. They held no independent inquiry had been conducted by the AO to establish that the persons to whom the SSC had sold shares were essentially exit providers. The AO had got completely swayed by the information available and did nothing on his own. So the current trend of in the last 1 year, penny stock, the judgments have been in favor of the SSC. Now the next two cases, which is judgment number 12 and 13, are Supreme Court cases dealing with revision, the power of the commissioner to revise an assessment order. The first case is where there is inflated purchases or bogus purchases. And the second case is vis-a-vis share capital. So two cases of Supreme Court, 263, inflated or bogus purchases and share capital. So as we all know, 263 for a commissioner to revise an order, that order must be erroneous and prejudicial to the interest of the revenue. And the commissioner must himself make an inquiry or cause an inquiry which he deems necessary before he passes an order. So he must himself take some efforts to say what is wrong in the order. So, very important point which was noted here is that there was no finding recorded that the books of accounts were rejected. So, in this particular case, the AO felt that the purchases and expenses were very high as compared to the receipts, the margin was very low. The SSC had produced the documents, but he could not produce all of it, and the AO made an addition of 5%, which was accepted by the SSC, and the commissioner felt that that was not adequate and he tried to revise the order, and the matter went ultimately to the Supreme Court and it was decided in favor of the SSC. So the findings are that there was no finding recorded by the AO in the books of account that the books are rejected. Specific issue, and tribunal held, if you see the last bullet, that the twin conditions that the order is erroneous or prejudicial to the interest of the revenue, it should be erroneous. So what is the mistake the AO has done? That was not pointed out, and this decision was taken in favor of the SSC. Now, a connected case of course, this was Supreme Court, on a connected case which is not on 263, but this is a case of Delhi High Court. Again, a latest judgment of Garg Analytics. So in this particular case, the AO alleged that the SSC was involved in transaction of bogus purchases and sale of goods and treated the difference between receipts from sales and payment for purchases as undisclosed income and made an addition. Since the AO had not recorded any finding that the books of accounts were rejected in entirety or that the assessment was made under best judgment, and since the net revenue which was added by the AO was already included in the declared income, the said addition was deleted as the same resulted in double taxation. So the recent Delhi High Court judgment in favor on the point. we come to the next judgment of a week on. We come to the, which is again Supreme Court 263. Now here, the AO had made sufficient inquiries with regard to share. The commissioner felt that the AO had not made sufficient inquiries with regard to share capital, and he passed a 263 order. So this is what was held. Ultimately, this matter was upheld by the Supreme Court, and it was held that the commissioner was wrong in revising the order. It was held that this case does not involve a failure by the AO to conduct an investigation. It's a case where the AO is having made the inquiries, erred in not making the addition. So the case of the commissioner is, if one goes by it, it's not that the AO has not made inquiry. The commissioner's case is that no addition is made. Now, if that what the commissioner wants to do, then he must himself revise the order and say, because of this reason, I'm making the addition under 68. He cannot tell the AO you are wrong without telling him why you are wrong. So, see, the times are changing. Today, even if I tell my subordinate, you are wrong, I tell my driver, you are wrong, he will tell me, you tell me why I am wrong. Before, the commissioner could just simply say, you are wrong and I'm revising the order. Now, the court is putting pressure on the commissioner and saying, if you want to do it, then do your effort. Tell him how he is wrong. Or you yourself revise the order and give him what to do. But you just cannot give a suggestion, just make a thing that you are wrong and make an addition. So the power under 263 third bullet can be exercised by CIT, but by going into the merits and making an addition, and not by an open remand just to investigate. This is very important. Many commissioners' orders say they don't agree with the AO, they're saying redo it. That's not the right way. Either you say what is wrong specifically and what is to be done specifically, but you just can't say redo it. And this is a Supreme Court judgment on this point. The distinction between failure or absence of investigation and a wrong decision was made. There's a difference. No investigation made and a wrong decision. And if there is investigation is made, you cannot tell him to reinvestigate. And if he has taken a wrong decision, then you tell him why it is wrong, and then you make the addition yourself. So this decision, SLP was dismissed, and the 263 was quashed. Now, similar case of Supreme Court, recent 2025 of NYA. Again, the 263 order was quashed because the commissioner felt that the AO had not looked into certain credit entries, but the fact was that he had looked into credit entries. In one of these earlier these cases, one line was there which said that the assessee does not hold the pen of the AO. One very important line that is. So if I have given everything to the AO and my letters are on record, my submissions are on record, and the AO chooses not to write that in the order, but he's convinced, time barring matter, that cannot go against the assessee because the pen of the AO is not in my hand how he should write the order. But he has done his job, which will come out from the record. And if that comes out from the record, you really cannot revise. The next case is of Ambadi Krishna, Kerala High Court. Now, this is a case what I call Satyameva Jayate. So, here is a case where 143(1) order is done. Summons is issued to me. And in the summons, it comes out that I have offered less capital gains for taxation. So an error I had made on vis-a-vis bonus shares. Now, bonus shares are not very regular kind of things. So there was an error I made vis-a-vis bonus shares. And when the summons were issued to me, I accepted with all honesty and said, yes, there is an error. And for this reason, the error happened. And I'm filing a return right away. I'm paying the tax right away. I'm also paying the interest on the tax right away, and all this was done. After this, but for the assessment, the AO had to issue 148 notice. And when he issued 148, there was no addition made. But he said this is concealed income. Because had I not issued you summons, you would not have disclosed the income. And therefore, I will make it as I'll levy penalty on you. Now, what is important is, if you see the section, if the AO during the course, in the course of any proceedings under the Act is satisfied that a person has concealed his income. So, for concealment, the AO has to be satisfied in the course of proceedings. This is what they held. So, Kerala High Court accepted. They said it is not in dispute that but for the investigation initiated by the revenue by issuing summons under 131, this differential income would have escaped assessment. They accepted that. Then they said, during the course of investigation initiated by the revenue, but before the conclusion thereof, the assessee had come and said, look, this is the income and he gave an explanation which was satisfactory, and 148 was there. Now, in the course of proceedings where the AO feels that there is concealment, can only be 148, because 131 summons is not proceeding under the Act. And they said in the 148 in the proceedings, you have not made any addition. So there is no question of the AO in the course of proceedings to realize that there is concealment of income. And this is what they held. This is what they held. So third bullet, 131 is not the initiation of any proceedings. And they noted this, that the assessee had paid the interest on the differential tax, etc. Last bullet, the honesty of an assessee cannot attract penal provisions under the Act. So I think a learning which comes out, which you can tell our client, if a summons comes, then be honest and do it, and one can take help of this judgment, satyameva jayate. So there was no ultimately concealment in this case because they noted the honesty of the assessee. With this, friends, as per schedule, in the 1 hour, I had planned to finish all 14 domestic tax cases, which we have finished right now. Now, before I come to international tax and TP, just a little bit, let's get familiar. I've taken cases of international tax and TP, which have an element of domestic tax. And I hope that by the session, we will feel that this international tax and TP are easy topics, nothing to worry about. So, the first case is that of a Korean company. As I said, the issue will come out from the facts will come out from the issue. So this Korean company had a PE in India where the PE had incurred a loss, a permanent establishment. So a foreign company can have a permanent establishment like a branch or a fixed place of business, or there can be other things also. So this foreign company, Korean company, had a permanent establishment and there was a loss. This foreign company had also earned fees for technical services from India, but it was not connected to the PE. So foreign company has a loss. It has FTS income. Now, if one goes by the treaty of Korea, then PE loss will come under business income. There's a separate article for that. FTS will come under a separate article. And there is no provision in any treaty that you can set off FTS against a business loss or things like that. And therefore, as Modi says, Atmanirbhar, we have to come back to we may go to treaty, but come back to our Act. And when you come back to our Act, when you come back to Section 70, then whether it is fees for technical services, whether it is PE loss, both of them are business sources. And Section 70 clearly provides that you can set off one loss from another gain from the same source, though the treaty does not provide for it. So the issue arose that can I come to once I'm a foreign company, I'm going to the treaty, and can I come back to the Act? And it was held that Section 90 subsection 2 says that the provisions of the Act, to the extent they are more beneficial to the assessee, he can do Atmanirbhar, come back and take the benefit here. And that's what he did. So that was the first hurdle which one had to cross here. The second hurdle now which came under the Act. If you look at Section 115 capital A, which talks of taxing fees for technical services at a flat gross rate, gross income at 20%. Section 115A 3 says that no deduction in respect of any expenditure or allowance shall be allowed to the assessee while computing this income of FTS. Now, the treaty is not giving me a provision of set-off. When I come to the Act is giving me provision for set-off. But FTS under the Act says it has to be taxed on a gross. You cannot even claim any expenditure or any deduction or any allowance from that fees for technical services. And here I want to claim a PE loss against the FTS income. Is it possible? So this is what the tribunal held. They said, let's look into the provisions of 115 BBH2. This provision talks of 30% tax rate on income from virtual digital asset. And they said, look at the language of this section. This section, like FTS, it's a flat rate of income. FTS is 20%, this is 30%. But this says no deduction in respect of any expenditure or allowance or set off of any loss shall be allowed to the assessee under the provisions of the Act, or set off of any loss. These words are not there in 115A, meaning thereby that if it's an FTS, then you can set off a loss, because they could have used the same language even in 115A for FTS. They said, okay, we'll go to another section, 115BBDA subsection 2, which talks of 10% tax on certain dividends received from domestic companies. And that section says no deduction in respect of any expenditure or allowance or set off of loss shall be allowed. So there are two provisions in the Act where their income is being taxed on gross basis. Two of them say that there will be no set off of loss allowed. One of them does not say so. And therefore, inferring from the Act itself, the PE loss could be set off against the FTS income. So now the issue arises is, in that particular case, the PE and FTS had no connection whatsoever. And one could go to the Act and treaty. So, the loss was under the PE and it was under the FTS was under the Act. Two different streams of income, Act and treaty. Now the issue arises, this happens typically in the case of Mauritian companies, is now, as you would be aware, in Mauritius companies, if shares are acquired prior to 17 and if a Mauritian company sells those shares, then it is exempt. If the shares are acquired after 2017, then they become taxable. Now let's take in a year, current year in 25, assessee has sold shares of X company, the name of the company, let's say Reliance, a Mauritian company, and the shares of Reliance were purchased prior to 17 and after 17, but both are Reliance. So prior to 17, there is a gain because it was purchased long back, and now at the sale there is a gain. And the Mauritius company takes a benefit of the treaty and says it will be exempt. And as far as 17 is concerned, the shares after 2017, there is a loss. And the Mauritius company says, look, I will not set off that loss against my gain, but I will carry forward that loss, or I will set that loss off against some other company. Now, mind you, here, the loss and gain is arising from the sale of shares of the same company. And the assessee is claiming treaty benefit for one and going under the Act for the other. And in all these decisions what are listed, it was held that it is permissible because section 90 subsection 2 says that to the extent the provisions of the Act are beneficial, you can take the benefit. And so one could even, same script. So it's, even if and they held, in these cases it is held, that each transaction of a share is a separate source of income. Each transaction. And therefore for one source or one transaction you choose treaty and the other you choose Act. So conceptually, this is what comes out from Yosung, is you can choose both Act and treaty, and both are not mutually exclusive. The next case we come to, which is also happening a lot these days, is a case of secondment. So here is a case where the foreign company seconded its employees to the ICO, Indian company. And these employees worked under the control of the Indian company. But for administrative convenience, the FCO paid the salary of the employees and the ICO reimbursed that to the FCO. And it applied for a certificate under 194(2) for nil withholding. The logic being, look, it is a reimbursement. There is no income to the FCO because what I have paid them, they have paid the employees. So there is a case of reimbursement. In any case, if one goes by the treaty, this foreign company does not have a permanent establishment in India. So If there was a business income, it would not be taxed. And the issue is whether it is fees for technical services of a foreign company, which normally can be taxed in India, even if there is no permanent establishment. But this was a US company, and US company has the famous what you call the make available clause. Make available clause says if if a particular service provider, or let's say the FCO, is rendering certain managerial, technical, or consultancy services which make available technology experience to the ICO, only then it will amount to fees for technical services. And they said, ki, look, once there is no make available, will not apply, because every year this is happening. Make available, what happens? If I make available technology to you, you will pay me today. But you will not pay me every year, year on year. Because if I made something available to you, why will you pay me year on year? So normally it's a yearly payments, make available does not take in. So this was the case. The AO rejected the case, and the matter went to the High Court in a writ under 194(2). And the High Court decided the issue in favor of the SSC and said, no, it will not amount to income in the hands of the FCO. Now, this is a case of make available. And I'll come to what if there are treaties where there is no make available. What if there is the FCO does not have a treaty with India at all, then what? But before I come to that, we are aware in the service tax law, there is a Supreme Court case in the case of Northern Operating Systems, where they held that in a case of secondment, there is a service element. So secondment amounts to service and it is liable for service tax. So if one goes by that Supreme Court judgment, then when there is a secondment, there is a service, and if there is a service, it will amount to fees for technical services. So there is a Delhi tribunal decision in the case of Serco, which distinguished Northern Operating on the facts of the matter in terms of control, etc. But we may not be able to succeed ourselves in all cases vis-a-vis Northern. So what comes out from the service tax matter is, at worst, a secondment is a service. But is that service FTS under the treaty because of make available? The answer is no. Now, what happens if the treaty does not have a make available clause? So we have the case of Advix, Delhi Tribunal, wherein they said that it was a case of pure reimbursement and there was no income element and no technical services, even in the case of where there was no treaty. And finally, if you come to a case where if you don't want to go to the treaty, you want to play safe, or your FCO is in a place where there is no treaty in India, can I get benefit from the Act itself? So if you see the definition of fees for technical services under the Act, see, this is the relevant provision. Section 1917, income by way of fees for technical services. For the purposes of this clause, fees for technical services would mean managerial, technical, or consultancy services, but does not include consideration which would become income of the recipient chargeable under the head salaries. So if this FCO is paying the salary to the employees here, these employees are being taxed in India. And ICO, am merely giving back reimbursing the salary back to the FCO. But the fact of the matter is, if you go by the definition of FTS, then the amount has already been taxed as salary in the hands of the employees. And we have two decisions, Morgan Stanley Singapore, Mumbai Tribunal, and HCL Infosystems Delhi High Court, where they took that particular exception under the Act itself, and they said that secondment will not be taxable. Now, whatever I have said with respect to secondment will equally apply to intra-group services. Except in intra-group services, you don't have that exception of FTS and salary and employees. But the same thing, whatever I have held here, whether make available, not make available, and I have written the decisions here, the same logic will apply even for IGS. So if an FCO is rendering IGS intra-group services to me, then the amount which I pay to them will not be taxable if the treaty has a make available clause. Now we come to a case of Benetton. Now this is a TP case. This is a transfer pricing case of intra-group service or secondment. So if there's an intra-group service being rendered and I am paying that my foreign company particular amount, or I am reimbursing them the secondment, can the AO say that the ALP of this transaction is nil because there is a loss, and since there is a loss, I have not benefited out of the transaction, and therefore I will treat this as the ALP of this transaction as nil. This matter went to Delhi High Court, and Delhi High Court said that this, whether a particular service is rendered, whether benefit is received, all these are things which in the domain of the AO. The TPO's job is to determine the arm's length price. He cannot step into the shoes of the AO. So if you see the second bullet, there's a difference between the functions of a TPO and AO. And the TPO is wrong to hold the ALP as nil because there is a loss. And they also held this, Delhi High Court, that merely because I'm paying rent to an associated enterprise and I've incurred a loss, I have to pay rent. That doesn't mean my rent ALP will be nil. So this approach of the TPO, that I will hold your international transaction to be at arm's length because you have a loss, has been demolished by the High Court. And these are the number of High Court decisions you see: Bombay High Court, Delhi High Court, Punjab and Haryana High Court, what you see on the screen, wherein they have said that TPO cannot do the functions of an AO under 37(1). However, the tribunal in the current scenario, what they are realizing is that the AO has missed the bus. And if you go by the High Court judgment, then the TPO cannot do the role of the AO. So they are currently remanding back the matter to the AO. But really, we need a bold decision which will consider all the High Court decisions in favor of the SSC, and a tribunal which will take those decisions and delete the addition. And we'll wait for such decision on that. So currently, the trend is of remand in matters like this in the tribunal. But if the matter reaches High Court, then the High Court is deleting the addition. The next case is that of Johnson. Now, this is a case of a foreign company. Foreign company gives guarantee to the banks outside of India. Those banks give credit facilities to the subsidiaries or the associated enterprise of the foreign company in India. The issue, and the Indian associated enterprise pay a guarantee fee to the foreign company. The issue is in the hands of the foreign company whether this interest income, whether it will be taxable, and if it is taxable, will it be taxable as interest, which is at a lower rate of tax of 15%? Will it be taxable as business income, which will be taxable only if there is a PE? Or will it be taxable as other sources? So this matter has gone to the Supreme Court. Supreme Court has held that this will not amount to interest income. Because if one goes by the treaty, then interest income can only arise from debt claims of every kind. Now, when the Indian AE or the subsidiary is paying the foreign company, that it is not in respect of a debt claim owned by the Indian company to the foreign company. So as far as the foreign company is concerned, there is no debt claim against the Indian company, and therefore it cannot be treated as interest income. Two, on the issue of business income, the High Court made a statement that in the appeal memo, while drafting the appeal memo, this ground was not raised. And they also said that the tribunal has not deliberated upon this issue, and therefore we'll keep this issue open. So this also points out that when we draft an appeal to the High Court, I mean, the role of drafting something properly has become pertinent these days. And because it was not taken as a ground, the High Court did not admit it. So this issue, whether guarantee fee will be business income or not, is an issue which is kept open. And the matter ultimately said that it will be other income. Now, if you look at other income article, this was the UK treaty. As per the UK treaty, other income will be taxable in the state in which the income arises. So if this guarantee fee arises in India, it will be taxable in India. If the guarantee fee arises in UK, it will be taxable in UK. That's what the article says. The Supreme Court held that the money is being utilized in India. The person who is paying the guarantee fee is in India. Therefore, the accrual happens in India and it arises in India. Now, there is a Delhi tribunal decision in the case of Capgemini, wherein they say that the guarantee is given outside of India. The people who are lending the money, the banks, are outside of India. The person who has given the guarantee is outside of India. And therefore, the accrual or the arising of income also happens outside of India. Now, though this is a Supreme Court judgment, it's a case of an SLP being dismissed without really getting, it's not an appeal which is decided on merits, it's an SLP dismissal. So this is not law of the land. So as far as Johnson is concerned in Delhi High Court, this has been upheld, it's the final order. But as far as we are concerned, we can say a non-jurisdictional High Court order is not binding. An SLP dismissal is not a case of, is not the law of the land. And therefore, there is still scope for a special bench to be constituted in Mumbai or elsewhere to decide both the issues, whether this will amount to business income or whether this will amount to accrual of income in India or outside of India. So these issues are kept open. So this issue was decided against the SSC on the basis of the language in the treaty, because the treaty says other income will be taxed in the state in which it arises. They held it arises in India and therefore taxable in India. But if you see these treaties you see on your screen, which is Cyprus, Georgia, Hungary, Iceland, Korea, Russia, Portuguese, Spain, UAE, in these treaties, this particular language of the UK treaty is not there. So if there is other income under these treaties, so if your FCO is in these jurisdiction, then the income by virtue of these treaties will arise outside of India and therefore yet not be taxable in India. So there is still a way out of this negative judgment. The next case is of Shapurji Palunji. Now this is a case where we spoke of the taxability of guarantee fee. Now we are talking about the arm's length price of various guarantees. So you may have a corporate guarantee, you may have a letter of credit, and you may have a performance guarantee. How does one determine the arm's length price of these guarantees? So if it's a financial guarantee, means I'm telling the bank, you give my associate enterprise the money, if he doesn't pay, I will pay. In this scenario, till now, 0.5% was being accepted because Bombay High Court and Everest Canto had upheld that 0.5%. The recent Bombay High Court judgment in the case of Piramal and Lakshya has said that the old Bombay High Court judgment is not a reasoned order. And therefore, that old law will not apply, and they remanded back the matter to tribunal to determine the ALP. So this issue will have to be determined as per the prescribed methods, and how that will happen is to be seen. Coming to performance guarantee. Performance guarantee can be of two types. One is like a finance guarantee, and the second is, look, I'm telling a particular client, you give Shapurji's case, you give this work to my associate enterprise, they will do it, and I guarantee the performance. This was the case here. Guarantee in such a way that if they don't do it, I will do it. And here the AO said that I am giving this guarantee on behalf of my associate enterprise, and therefore I must have charged money. I should charge from my associate enterprise something, and made an addition. The tribunal held, look, when there is like a novation of contract, if I step into the shoes, so the contract, the obligation is mine that I will do his work, but the revenue is also mine. So there is no, in that sense, there may not be any impact on my P&L in a negative way. And in this particular case, the deduction, the performance guarantee, the addition was deleted because it was a case of novation. And letter of comfort, what was held here? What is a letter of comfort? Suppose I say, give my associate enterprise the money and I shall pay you if they don't pay. Then that is clearly a finance guarantee. It's an international transaction for which there will be an addition made. But if I say, okay, this is my associate enterprise and I will continue to hold money in there. If I use the language, I will continue to be a shareholder there. I will continue to the parent. It may give comfort to the bank, but there is no obligation on my part. Or if I say that my associate enterprise, your loan, I tell the bank will have priority over mine. Or I make a general statement to the bank that I will ensure that my AE is always well equipped and is sufficiently funded. When there are these general statements being made, I'm just giving comfort to the lender, but I'm not taking an obligation on myself. And in Shapurji's case, the letter of comfort was something like giving a comfort. So one can really play around with the language of your letter of comfort, where the other person gets comfort, but you don't get any relief. I mean, you don't have any obligation. So I remember this actually happened. I asked many years back somebody that I hope you will come for my party. And his words were, it has stayed in my mind. He said, most likely I will definitely come. So I said, definitely come. I took it, he will come. When he didn't come, he said, but I said, most likely I will definitely come. So you're neither here nor there. He's comforting me, but there is no obligation on him. So a letter of comfort, if it is of that kind of a language where it comforts the other person, and many are such, in the presentation when you see, you will see I've covered some language there. It's just comforting without an obligation. In such a scenario, there will not be any arm's length addition. And the last case is of Allahabad High Court in Phoenix Lamps, the last case here. And here it is whether an addition can be made on account of outstanding receivables. So I have some receivables from my AE. Can the AO make an addition? Okay, Baba, you are giving him credit facilities. You are in a way lending money to him and make an addition. And the High Court has held that if a working capital adjustment is given, then no addition can be made. Or if my main transaction at my AE is at arm's length. So let's take I have a cousin of mine who I know if I render service to him, he will pay me after a year. And I have a other client of mine who I know will pay within 1 month. Suppose to that client who will pay within 1 month, I'm charging 100 rupees. To my cousin, I know okay, he's going to pay after this and I'm charging him 120 rupees. I know he's going to delay it. Can the AO say, oh, he's your cousin, your associate enterprise, you have given him credit for 1 year and therefore I'll make an addition? The answer is, but you see, even if you add a bank interest of 8%, I should have charged him 108, but I've charged him 120. So the courts are taking the view that you see the principal transaction if it is at arm's length, and if the principal transaction is at arm's length, then no addition should be made. Or if I'm giving similar credit terms to AEs and non-AEs, if I'm doing sab ek saman hai, then also no addition should be made. So this is the last case on the High Court. But most important, I have just few minutes left, is this almost 87 minutes, 3 minutes made the juice of all this. What comes out, the key takeaways from all these cases, that in the case of transit rent, it would be a capital receipt and not liable for TDS. Any interest amount in an auction, if any deposit is made, which is cancelled and I get back the interest, then it will be a capital receipt. CAM charges, which I pay, will not be rent. A reduction in share capital will amount to a transfer, and any loss arising therefrom I'll be able to claim it or set off or claim it forward. In case of a letter of allotment, the letter of allotment will be the date of acquisition and the long-term period can be considered from that perspective. Even if an asset is a depreciable asset under 50, which is short-term, one can claim a tax rate of long-term, which is 20%. 54F will even apply to an under construction flat, even if the flat is not constructed. And the exemption cannot be denied because the registration is in the name of my family member. In a reverse scenario also, no addition can be made because my brother and I are party to the same transaction and he has offered it for tax. Even if I bought A duplex or triplex 54F cannot be denied to me. What is important is the use as a single residential unit. And even if there is a residential unit which is being used as for non-residential purpose, like a mosque or a school, I will not get the exemption. If my main business is of letting out, then notwithstanding earlier Supreme Court decisions, the rental income will be income from business. In case of redevelopment, 56(2) will not apply because it will be covered under capital gains. So if there is an exchange of flats or tenancy, it will not apply. If I make a payment to a broker to get my principal amount back from the builder, then that amount which I pay to the broker will be allowable under 57(3). In penny stocks, if you have proper documentary evidence and if there is a period of holding is long, the transaction is through banking channels, if there is a preferential allotment or an amalgamation is approved by the court, it may be possible to argue to give me exemption under 1038. Then a revision cannot happen merely because the commissioner does not agree with the AO. He must give his reasons for it, whether it is for share capital or bogus purchases. A PE loss can be set off against FTS income, notwithstanding the language that it is taxed on gross basis. In case of secondment, the money which I pay to the FCO will not be taxable. Same for intra-group services, the money which I paid will not be taxable. Guarantee fee which I pay to my FCO will not be interest, but it may or may not be business income and not taxable under the act which is to be tested. If it is other income, then depending where my FCO is situated, if it is in a place like Russia or UAE, it will not be taxable. But if my FCO is in UK, it will be taxable. And a letter of comfort is clearly not an international transaction on which no addition can be made. A performance guarantee where there is a novation of contract, where the obligation and the contract revenues flow to me, is not an international transaction and no addition can be made. For financial guarantees, it will have to be seen what prescribed method is applied and followed. And for outstanding receivables from my sister concern, if a working capital adjustment is given or my main transaction is at arm's length, then no addition can be made. And I think with that, I finished my 90 minutes.